Hello, everybody. I'm recording this on January 6th, 2022, and this is an addendum to Module 6 dealing with the foreign tax credits. Um, I'm recording this lecture to address the recently released foreign tax credit final regulations, which at least in this writing is not reflected in your text. It's possible that your text will have an update between now and when the course begins, but I'm not counting on that. So I want to give you a summary of some of the more important aspects of those regulations. As I said in my earlier lectures regarding foreign tax credits that were recorded in December 2021, I indicated that final foreign tax credit regulations were due out shortly. The final regulations, which is TD 9959, as you may know, TD stands for Treasury Decision 9959. In fact, were released on December 28th, 2021, and were officially published on January 4th, 2022 in the Federal Register. I want to provide you with a brief summary of some of the more important aspects of these final foreign tax credit regulations, especially those impacting sections 901 and 903. The regulations cover a number of other areas that I'm going to omit in an introductory course on U.S. rules regarding international taxation. Let me tell you at the outset, I'm not going to test you on these final regulations, but obviously having a knowledge of these final regulations, will be beneficial in terms of your day-to-day practice. I also intend to upload on modules on the website in Module 6 a summary of the regulations prepared by either Ernst & Young or another one of the accounting firms. Hopefully I'll get an Ernst & Young summary, which I guess is politically correct for you guys. The 2021 final regulations very importantly impose an attribution requirement that must be satisfied for a foreign levy to qualify as a foreign income tax under both sections 901 and 903. And furthermore, provides the net gain requirement that must be satisfied for a foreign levy, tax, to qualify as a net income tax under section 901. The 2021 final regulations, these are the foreign tax credit regulations, finalized from the proposed regulations, what was then known as a jurisdictional nexus requirement as part of the net gain requirement to be a creditable income tax under section 901, and renamed what was referred to originally as a jurisdictional nexus, renamed an attribution requirement. This reflects its role in determining the gross receipts that must be appropriately included in the foreign tax base. Thus, under the 2021 final regulations, a foreign tax must satisfy a jurisdictional nexus requirement, now referred to as the attribution requirement, to qualify as a net income tax eligible for foreign tax credit relief under section 901. Furthermore, a foreign tax also must satisfy the attribution requirement to qualify as an in lieu of income tax under section 903. The introduction of a jurisdictional nexus test was motivated by the proliferation of taxes enacted by many foreign jurisdictions that Treasury, the U.S. Treasury Department, believes are inconsistent with international norms of taxation. In that vein, the preamble of the proposed foreign tax credit regulations that were issued in 2020 expressed a concern that allowed a foreign tax credit for these novel extraterritorial taxes, such as a digital service taxes, which would undermine the purpose of the foreign tax credit to mitigate double taxation of income that is properly attributable to taxpayers' activities or investments in a foreign country. That is income over which the foreign country would have the primary taxing right under traditional international tax principles. The preamble to the 2021 final regulations reiterate Treasury's belief that a tax asserted by a foreign jurisdiction based on the location of customers or end users or similar destination-based criteria is inconsistent with the international norms of taxation and should not be creditable. The attribution requirement achieves this aim by providing an exclusive set of criteria that may form the basis for taxation of non-residents by a foreign jurisdiction, which would generally prevent the creditability of things like a digital service tax and other destination-based taxes. I think I mentioned to you in an earlier lecture that the OECD, the Organization of Economic Cooperation and Development, with the support of the US, is currently finalizing a new international tax framework that would create a limited taxing right with respect to the largest and most profitable companies based on the location of their ultimate customer end user. This is known as Pillar 1. If Pillar 1 is ultimately implemented, taxes imposed under the new taxing right, under these final 2021 final foreign tax credit regulations generally would not satisfy the attribution requirement and thus not be entitled to foreign tax credit relief. The preamble to the 2020 proposed regulations noted that in the event a multilateral agreement is reached on Pillar 1 that includes the United States, further changes to the United States foreign tax credit system may be required. However, the preamble to the 2021 final tax credit regulations also provide that because the current proliferation of extraterritorial taxes currently threaten the US FISC, that is the US Treasury, the potential for future law changes should not delay the adoption of the attribution requirement. So I think the bottom line is if Pillar 1 is indeed implemented and effective in the United States, that these regulations will be modified, but no guarantees. The attribution requirement provides separate rules to determine whether a foreign tax is creditable, whether the tax is imposed on residents or non-residents of the jurisdiction imposing the tax. For a tax on non-residents to be creditable, again, by credible I mean eligible for US foreign tax credit, it must meet one of three attribution requirements. And these are: 1, activities-based nexus; 2, source-based nexus; or 3, property-based nexus. You don't have to meet all three. You've got to meet at least one of the three. Under the activities-based nexus test, the gross receipts and cost included in the foreign tax base must be determined under reasonable principles by reference to the non-resident's activities, including its functions, assets, and risks located in the foreign country. The effectively connected income, or ECI standard, ECI we talked about, acronym for effectively connected income, under code section 864C, little c, in parenthetical, is the sole example cited of reasonable principles for attributing income to activities. Importantly, the regulations provide that a tax based on the location of customers or users would not be creditable under this standard, nor would a tax based on the location of persons from whom the non-resident makes purchases. The activities-based nexus test was clarified in the final regulations to provide that reasonable principles do not include rules that deem the existence of a trade or business or permanent establishment, which is a tax treaty term, based on the activities of another person, unless the other person is an agent or otherwise acting on behalf of the non-resident or is a pass-through entity to which the non-resident is an owner. Under the source-based nexus test, which is a separate test, again, you have to meet one of these three, for a tax based on a source of income rather than on activities to meet the attribution requirement, the foreign law sourcing rule for a category of gross income or subset thereof must be reasonably similar to the US sourcing rule. The 2021 final regulations expand upon the source-based nexus requirement contained in the 2020 proposed regulations with the intention of providing additional flexibility and clarity. To provide additional flexibility regarding the extent to which the US and foreign law must align, the 2021 final regulations provide that foreign tax law generally applies for determining the character of the gross income or gross receipts. For example, as sales income or services income that are subject to the foreign tax. The 2021 foreign tax credit final regulations, however, provide a notable exception to the deference to foreign law characterization in respect of copyrighted articles. The relevant foreign law must treat the transaction that is treated as a sale of copyrighted article for US purposes as a sale of tangible property rather than as a license. You get a drink of water. To provide additional certainty regarding the meaning of the foreign sourcing law being reasonably similar to a US sourcing rule, the 2020 proposed regulations provide a per se rule for when a foreign law sourcing rule for services could be considered reasonably similar to a US sourcing rule, namely that such income must be sourced based on where the services are performed, as opposed to the location of the service recipient. The 2021 final regulations finalize this requirement and additionally provide that for a sourcing rule for royalties to be reasonably similar to a US rule, royalties must be sourced based on the place of use or the right to use the intangible property. Also, with respect to source-based nexus, the final regulations add a sentence to Reg Section 1.901-2, little b in parenthetical, 5 in parenthetical, I in parenthetical, cap B in parenthetical, providing that a foreign tax law's application of such sourcing rules need not conform in all respects to the application of sourcing rules for federal income tax purposes. The preamble to the final regulations state that this change is intended to add flexibility in applying the source-based nexus requirement. As an example of this flexibility afforded by this addition, the preamble states that while royalties must be sourced based on place of use of the intangible, foreign law need not reach the same conclusion as US tax law regarding the place in which the intangible is used. The third alternative test to meet the attribution requirement set forth in these final regulations to be a credible foreign tax is a property-based nexus test. The property-based nexus test provides the conditions that must be satisfied for a foreign tax imposed on the sale or disposition of property by a non-resident based on the situs of the property to satisfy the attribution requirement. Gross receipts from disposition of property, including corporate stock or an interest in a partnership or other pass-through entity, included in the tax base of a foreign jurisdiction on the basis of real property located therein, must be determined under rules reasonably similar to the U.S. Foreign Investment in Real Property Tax Act, referred to as FIRPTA, under Section 897. If you recall, we briefly touched upon FIRPTA in the introduction in the first module of the course. And there's a brief description of how FERPTA operates in chapter 65 of the Loken text. One commentator pointed out that under the 2020 proposed regulations, a foreign tax levy, a foreign tax law identical to FERPTA did not appear to satisfy the property-based nexus requirement because such tax base could include a portion of the gain from a sale of shares in a company that owns real property situated in the country that does not correspond to gain in such real property. Under FERPTA, a non-resident's entire gain on the sale of shares of a U.S. corporation is subject to U.S. tax if the fair market value of the U.S. real property interest held by such corporation exceeds 50% of the corporation's real property interest in other trade or business assets. But the 2020 proposed regulations had suggested that only the portion of the gain on the shares attributable to real property located in the foreign country may be included in the country's tax base, rather than the entire gain on the shares. The modifications made by the 2021 final regulations align the property-based nexus requirement with respect to real property with the FERPTA regime. Just to be clear, I think I mentioned to you under FERPTA, 50%, I'm not sure if it's 50% or more than 50% of a publicly traded corporation's assets are real property, then the corporation is considered to be subject to FERPTA. I just don't recall offhand whether it's 50% or more than 50%. I apologize. One observer commented that while the attribution requirement was largely aimed at the recent proliferation of novel extraterritorial taxes, such as digital service taxes, the attribution requirement also denies credits for taxes with a longer history of being heretofore creditable under U.S. tax. For example, many jurisdictions tax the gain from the sale of shares of resident corporations without regard to whether the shares constitute real property interest or themselves attributable to a trade or business in the jurisdiction. The preamble to the 2021 final regulations make clear that those taxes are not creditable absent the application of an applicable tax treaty. In contrast, akin to the U.S. rules, foreign tax imposed on gains and disposition of a partnership interest may satisfy the property-based nexus requirement imposed under rules similar to Section 864, little c in parenthetical, 8 in parenthetical, which generally treats certain gains from the sale of partnership interest, by a foreign corporation or a non-resident alien individual as income effectively connected with the conduct of a trade or business in the U.S. to the extent gained from the sale of assets held by the partnership would be so treated. I think I briefly mentioned 864 C8 in the class in an earlier module. Not certain of that. The 2021 final regulations expressly defer to U.S. tax treaties by providing that a foreign tax that is treated as an income tax under an applicable income tax treaty that the United States has entered into with the country imposing the tax meets the definition of a foreign income tax as to U.S. citizens and residents of the United States that elect to claim benefits under that treaty. Because the CFC is not eligible to claim benefits under a U.S. tax treaty, the same foreign levy may not be creditable as a deemed paid tax, under subpart F or guilty regimes that we discussed earlier, if it does not satisfy the attribution requirement. That could be a problem. As noted, I'm just stop for a second. 2021 final regulations under Section 903 also require a foreign levy to meet the attribution requirement in order to qualify as in lieu of tax under Section 903 by requiring that the attribution requirement would be satisfied if a net income tax were instead imposed with respect to the income tax subject to the in lieu of tax. In particular, withholding tax must satisfy the source-based nexus requirement. One observer noted that the attribution requirement for in lieu of taxes, including withholding taxes, under Section 903 generally makes withholding taxes imposed on payments for services performed outside the taxing jurisdiction non-creditable. Even, however, if a jurisdiction's withholding tax does not meet the attribution requirement with respect to services, it may meet the attribution requirement with respect to royalties. In some cases, it may be possible to restructure to provide for a royalty rather than a service fee. I'm going to come back to Section 903, the regs on 903 later. Let's now focus on the change to the net gain requirement to be creditable income tax under the 2021 final regulations. Recall we studied the net gain requirement as part of Module 6, and it was covered in your book, but now we're going to talk about, some modifications. Some of the rules remain the same, but some modifications to net gain under these final 2021 regulations. For a foreign levy to qualify as a net income tax, the prior foreign tax credit regulations required a factual inquiry as to whether the predominant character of the tax is that of an income tax. The predominant character analysis, as we discussed, required a determination as to whether the tax is imposed on net gain in the normal circumstance in which it applies. Whether a tax is imposed on net gain has historically required a tax to meet three requirements that we discussed earlier in the semester: realization, gross receipts, and net income. Determining whether a tax satisfied the net gain requirement had historically required a fact-intensive analysis, which the Treasury Department characterized as administratively burdensome in the preamble to the 2021 final regulations. For example, a tax that is not imposed with respect to actual gross receipts could satisfy the gross receipts requirement under the prior regulations if the tax base computes gross receipts under a method that is likely to produce an amount that is not greater than fair market value of the actual gross receipts. As an additional example, the net income requirement could be satisfied under the prior regulations if the taxpayer is permitted to deduct amounts computed under a method that is likely to produce an amount that approximates or is greater than the actual costs and expenses incurred by the taxpayer that are attributable to income included in the tax base. The 2020 proposed regulations had retained the net gain requirements, but introduced some significant changes. So the standard applies based on the terms of the foreign tax law itself to address the uncertainties and administrative difficulties that the Treasury perceives arose under the empirical analysis required under prior law. The 2021 final regulations are largely consistent with the approach of the 2020 proposed regulations, but include several modifications in response to comments. Under the 2021 final regulations, the net gain requirement includes the new attribution requirement described above, and retains revised versions of the realization requirement, the gross receipts requirement, and the requirement for the allowance of significant cost recovery, what was referred to as the net income requirement. Under the final foreign tax credit regulations, the realization requirement generally may be satisfied in one of three ways. First, the requirement is satisfied if the foreign tax is imposed in connection with or subsequent to an event that would be a realization event under U.S. tax principles. Second, foreign tax may be imposed upon a pre-realization event that results in the recapture of a prior tax allowance accorded to the taxpayer. Finally, the foreign tax may be imposed upon certain pre-realization timing difference events, such as a mark-to-market regime or a deemed distribution or inclusion regime, as long as a second tax is not later imposed with respect to the same income, unless a credit is granted with respect to the second tax, the tax paid in connection with the pre-realization timing event. These provisions, I believe, are consistent with the prior regulations that we studied. The idea of allowing mark-to-market, recapture, et cetera. The 2021 final regulations also provide helpfully that the inclusion in the tax base of insignificant amounts of income measured based on the application of the tax to all taxpayers that is not tied to realization or pre-realization event, and therefore does not meet the realization requirement, does not prevent qualification of the tax as a net income tax. Consistent with the general goal of minimizing empirical analysis, the 2021 final regulations removed the general rule in the gross receipts requirement that allowed computation under a method that is likely to produce an amount not greater than gross receipts, and instead requires the foreign tax be imposed on actual gross receipts or deemed gross receipts in respect of a pre-realization event or pre-realization timing difference event. In addition, in connection with the insignificant non-realization amount or a realization event that does not result in actual gross receipts, the 2021 final regulations allow for tax to be imposed on an amount reasonably calculated to not exceed fair market value. We pause for a second. Pursuant to the 2021 final regulations, the cost recovery requirement is satisfied if the tax base allows the recovery of significant costs and expenses attributable to the gross receipts included in the tax base. In connection therewith, the regulations specify certain significant costs and expenses that must be allowed as a deduction for the cost recovery requirement to be satisfied, which are capital expenditures, interest, rents, royalties, wages, or other payments for services, and research and experimentation. Again, they want to make sure, like in the prior regulations, the income tax is not based on gross income, but on net income. Otherwise, empirical analysis is still required for determining whether a cost or expense is significant based on whether the expense constitutes a significant portion of the taxpayer's total costs and expenses, considering all taxpayers to which the tax applies. The imposition of disallowance under foreign law consists with the principle of U.S. tax. For example, Section 163J, limiting interest expense deductibility in certain cases, and Section 162 does not prevent satisfaction of the cost recovery requirement. The 2021 final regulations introduced a limited exception to the cost recovery requirement that allows foreign tax to be creditable, even if the foreign tax does not provide for cost recovery to satisfy the cost recovery requirement if there are no significant costs attributable to the gross receipts included in the tax base. Furthermore, the 2021 final foreign tax credit regulations provide additional flexibility in that cost recovery requirement may be met if the foreign tax regime that allows taxpayers to choose to either I, deduct the actual costs and expenses, or to utilize, deduct an optional allowance in lieu of actual costs and expenses. where the foreign tax does not allow for the recovery of significant expenses, the cost recovery may be satisfied if the foreign tax provides an alternative allowance that by its terms is never less than the actual amount of the expense. An alternative allowance may also be allowed in the case such allowance is provided pursuant to a small business exception in the foreign tax regime. Stop for a second. Again, none of this will be on the exam, but it could certainly affect the work you do, which is the most important thing. The provisions of 2021 final regulations modifying the qualification of tax as a foreign income tax apply to foreign income taxes paid or accrued in tax years beginning on or after December 28, 2021. So they generally apply to a calendar year taxpayer beginning in 2022. However, a special one-year deferral rule applies with respect to certain controversial taxes, excise taxes paid to Puerto Rico under Section 1035.05 of the Puerto Rican Internal Revenue Code of 2011 as amended. For these particular taxes, these revised rules under Section 901 will not apply until January 1st, 2023. Let's focus a little more on the changes made in the 2021 final foreign tax credit regulations to the Section 903 in lieu of income tax regime. As we discussed earlier in the class or in the course, Section 903 allows a taxpayer to take a foreign tax credit in respect of certain foreign taxes paid in lieu of a tax on income, war profits, or excess profits imposed by a foreign country or U.S. Possession, which is referred to as in lieu of tax. And in lieu of tax is not subject to net gain requirements, and therefore its base may be gross income or receipts, like a withholding tax. Like the withholding tax in the hypothetical I gave you, where we had a Swiss licensee pay royalties to IBM, which had licensed a Swiss patent to the Swiss licensee. The Swiss withholding taxes, would generally should meet the requirements of an in lieu of tax in Section 903. The regulations under Section 903 provides requirements that must be satisfied in order for such a tax to be creditable. The 2021 final foreign tax credit regulations retain the basic requirement of prior regulations that the qualifiers in lieu of tax under 903, a foreign levy must, one, be a tax as determined under Reg Section 1.901-2, little a in parenthetical, 2 in parenthetical, and 2, satisfy a substitution requirement. However, the 2021 final regulations would substantially modify the substitution requirement to include 4 requirements that must be satisfied in respect of the tested tax that is not a covered withholding tax, or the tested tax must instead qualify as a covered withholding tax. Not tax, 903 would cover, say, a tax that's imposed. So let me give you an example. I think I talked about this earlier, just to make sure everybody's in the same wavelength. Suppose a jurisdiction normally has an income tax, but for banks, they have a tax based on capital, an excise tax based on capital that would normally be considered and in lieu of tax under Section 903. So let's go through these requirements under the final regulations governing 903. Under the first prong, excuse me for a second, wait for 1 second, I'm sorry. Under the first prong, the foreign jurisdiction was generally imposed a net income tax as defined under Reg Section 1.901-2, little a in parenthetical, 3 in parenthetical, which is referred to as the generally imposed net income tax requirement. Under the second prong, neither the generally imposed net income tax nor the other net income tax may be imposed by a foreign country on income to which the base of the tested tax relates. It should be noted that a foreign tax is either creditable or not creditable with respect to all taxpayers, and that the credibility of a given tax is not determined on a taxpayer by taxpayer basis. Therefore, in order for this second prong, referred to as the non-duplication requirement, to be satisfied, no taxpayer that is subject to the tested tax may be subject to any net income tax imposed by the foreign country in respect of the excluded income. Under the third prong, the imposition of the tested tax must bear a close connection to the failure to impose the generally imposed net income tax on the excluded income, which is sometimes referred to as the close connection requirement. The close connection requirement requires that the foreign jurisdiction deliberately excluded the excluded income from its net income tax in favor of subjecting it to the tested tax. Like in my example with the bank, with a jurisdiction that specifically says that banks aren't subject to an income tax. Instead, they're subject to a tax, based on excise tax based on capital. A close connection exists if the generally imposed net income tax would apply by its terms to the excluded income, but for the fact that the excluded income is expressly excluded. Again, for banks, they're not taxed on, in my hypothetical, in this foreign jurisdiction, in my hypothetical, the banks are not taxed on net income. The 2021 final regulations also provide that a tested tax enacted contemporaneously with the generally imposed income tax may satisfy the close connection requirement if such income tax does not apply to the excluded income. If the tested tax is not enacted contemporaneously with the generally imposed net income tax and is not accompanied by an amendment to such net income tax that excludes the excluded income from such tax, a close connection can only be established by the legislative history of the tested tax or its predecessor. The fourth prong of these final regulations requires that the generally imposed net income tax or hypothetical new tax that is a separate levy were applied to the excluded income. The generally imposed net income tax would meet the attribution requirement we discussed earlier, which is provided for in Reg Section 1.901-2, little b in parenthetical, 5 in parenthetical. Just pause for a second. Under the 2021 final regulations, the substitution requirement is satisfied in respect of tested tax that qualifies as a covered withholding tax, defined term. Covered withholding tax is a defined term in the final regulations. The definition of covered withholding tax incorporates certain of the 4 requirements described above that apply to tested tax, not covered withholding taxes with modifications, but does not incorporate the close connection requirement. In order for a tested tax to qualify as a covered withholding tax, the generally imposed net income tax requirement must be satisfied. Additionally, such tested tax must be a withholding tax imposed on gross income of non-residents of taxing country and must not be imposed in addition to a net income tax imposed on the same income. Finally, well, I guess not finally, but the income subject to the tested tax must satisfy the source-based nexus requirement we mentioned earlier, which generally requires the income tax be sourced the country imposing the withholding tax on the U.S. principals. The foregoing modifications of Reg Section 1.903-1 in respect of the in lieu of taxes apply to foreign taxes paid or accrued in tax years beginning on or after December 28th, 2021. However, as we talked about earlier, a special one-year deferral rule applies with respect to certain taxes paid to Puerto Rico under the reference here is Section 3070.01 of the Puerto Rican Internal Revenue Code of 2011 as amended. And for these Puerto Rican taxes, these new regulations apply beginning on or after January 1st, 2023. Tax years beginning on or after January 1st, 2023. Let me quickly address a few more changes made by the 2021 final regulations. There are rules concerning separate levies, whether a foreign levy imposed by a given jurisdiction qualifies as foreign income tax determined separately any other foreign levy imposed by such jurisdiction. I'm not going to go through these rules in the interest of time. Again, I'm not testing you on any of it. Let's quickly address the impact of the 2021 final regulations with respect to compulsory or non-compulsory payments. Remember, if a tax is non-compulsory, it's not credible. The 2021 final regulations clarify that the non-compulsory payment rules require taxpayers to take reasonable steps to minimize foreign income taxes and not foreign taxes as an aggregate. Generally, a foreign amount paid is treated as a compulsory payment if the taxpayers are reasonably interpreted and apply the relevant foreign tax law and exhausted all effective and practical remedies to reduce its foreign income tax liability over time. That's consistent with prior law. Pursuant to the 2021 final regulations, such determination is made without taking into account the time value of money. I think that's also consistent with prior regulations. The 2021 final regulations include new guidance regarding the efforts taxpayers must undertake to minimize their foreign income tax liability. Specifically, the 2021 final regulations provide the requirement to minimize foreign income tax liability is met to the extent that the reasonably expected arm's length cost of reducing the foreign income tax liability would exceed the amount of the potential reduction. For purposes of the reasonable cost analysis, the 2021 final regulations provide that reasonably anticipated foreign non-income tax liabilities may be taken into account as relevant costs. The 2021 final regulations also clarify the rules applicable for determining whether the taxpayer has reasonably interpreted and applied foreign law. The 2021 final regulations add that voluntarily foregoing a tax benefit to which a taxpayer is entitled under foreign law results in a foreign payment in excess of the foreign taxpayer's liability for foreign income tax, and thus the foreign tax is not credible. I think that too is consistent with prior regulations. The 2021 final foreign tax credit regulations provide that if a taxpayer has the option to determine its foreign income tax liability under only one of a multiple separate levies, each of which is a foreign income tax under foreign law, then the amount of foreign income tax paid equals the smallest liability of the amounts that would be due under each of the alternative levies, regardless of which levy the taxpayer uses to determine its foreign income tax liability. The 2021 these regulations also apply with respect to these non-compulsory foreign tax credit rules are also applicable to foreign taxes paid or accrued in tax years beginning on or after December 28th, 2021. So January 1st, 2022 for calendar year taxpayers. The 2021 final regulations provide detailed rules that clarify when a foreign tax credit may be claimed by either a cash method or accrual method taxpayer pursuant to Section 905A and consistent with existing regulations. A cash method taxpayer may make an irrevocable election under the 2021 final regulations to credit foreign income taxes in the year in which they accrue. Reg section 1.905-1 little d in parenthetical contains detailed rules for determining the foreign tax credit under an accrual method. That regulation contains the general rule that foreign income taxes accrue in the tax year in which all events have occurred that establish the fact of liability, and the amount can be determined with reasonable accuracy and cross-references the applicable regulations under section 446 and 461. Presumably, you've at least been introduced to the regs under 446 and 461 in your tax accounting course. A foreign income tax determined on the basis of a tax year becomes fixed and determinable at the close of the taxpayer's foreign tax year, and therefore accrues in the U.S. tax with or within which the foreign tax year ends. I think that is consistent with the prior regulations. Foreign withholding taxes imposed on a payment giving rise to an item of foreign gross income accrue on the date the payment from which the tax is withheld. Tax that's withheld is made or is treated as made under foreign law. Reg section 1.905-1D also addresses the application of something known as the relation back doctrine to additional foreign income taxes paid by an accrual method taxpayer that relate to a prior tax year. That regulation, which is 1.905-1D, provides additional foreign income tax paid as a result of a change in foreign tax liability, including as a result of resolution of a contest with a foreign tax authority, relates back and is considered to accrue for foreign tax credit purposes at the end of the foreign tax year with respect to which the taxes were imposed, which is referred to as the relation back year. Under Reg section 1.905-3, little a in parenthetical, foreign income taxes that are not paid within 24 months after the close of the tax year in which they are accrued are treated as refunded and result in a section 905C foreign tax credit redetermination. That again, I think is consistent with prior law. Reg section 1.901-1D, little d in parenthetical, provides that when such taxes are subsequently paid, another section 905C foreign tax termination occurs, and the foreign taxes are allowed as a credit in the relation back year. The 2021 final regulations provide as a general rule that foreign tax credit for a contested income tax liability cannot be claimed by an accrual method taxpayer until such time as both the contest is resolved and the tax is actually paid. Thus, an accrual method taxpayer generally cannot claim a foreign tax credit for a contested foreign tax, even if remitted to a foreign government before the contest is resolved. This is, I think, a change from prior law. The 2021 final regulations provide an exception to this general rule, however, that allows a provisional foreign income tax credit in the relation back year to the extent the taxpayer remits the contested amount to the foreign country pending settlement of the dispute. There are, however, some conditions that must be satisfied that I'm not going to go into. I've certainly not covered everything that deals with in the regulations that deal with section 901 and 903. As I said, I intend to upload a summary of these regulations, hopefully prepared by Ernst & Young. Once you go through it, if you have questions, you can always email me, but none of this will be on the exam. Okay, everybody, have a great day and do take care. Bye.